Hi, this is David. Welcome to today's presentation. We are looking at financial intelligence for financial freedom. The topic is very important for everybody because we are all looking forward towards attaining financial freedom. First, I want us to look at the meaning of financial freedom or financial independence. Financial freedom is the ability to live from the income of your personally invested resources. What do I mean? We all do one thing or the other to get money. Now, so long as you keep depending on the salary or wages you get from your daily work, you're not financially free. Because the day that primary source of income, your job, your business stops, you stop getting money. You become poor. You're not financially free. A financially free person is that person that keeps earning money even after the primary source of income stops. As we go down this presentation, you will understand more of what I just said. Secondly, financial freedom is when you get to a point in your life where you work by choice and not necessity. You choose to work by choice, not because if you don't work, you won't eat. At that point, you're financially free. What do you mean by financial intelligence? It is the knowledge and skills you gain from understanding finance and accounting principles in the business world. We are looking at two things: cash flow quadrant and cash flow patterns. Now, if you understand these two things, you will gain financial freedom. What is cash flow quadrant? There is a popular author, an American author called Robert Kiyosaki, who came up with this model. Now, looking at the screen, you will observe that the screen is divided into four quadrants. Right? It's divided into four quadrants. The E and the S quadrant on the left, the B and the I quadrant on the right. If you've seen this before, fine. If you've not seen this before, please pay attention. Understanding of this diagram will help your financial life. Now, the E quadrant stands for what? Employee. Anyone watching this video that is working for salary or wages is in the E quadrant. You're an employee working for someone. You are in the E quadrant. S stands for self-employed. Self-employed are those that are called professionals. They have specialized skills, like the doctors, the lawyer, engineer. They render their specialized skills in exchange for money. The B stands for business owners, big business owners. These are the CEOs of corporations, the CEOs of banks, multinational companies. These are the big business owners who have employees working for them. And the I stand for investors quadrant. These people don't work. These people don't run businesses directly. What works for them is their money. They give out their money make more money in return for them. Now, let's go further to expatiate on this. The E quadrant are the employees. This is the most dangerous place to remain if you want to attain financial freedom. What do I mean? Out of these four quadrants, the employees have uncertainty in terms of finance. What do I mean? Their future is controlled by the employer. The money they make, the amount of money they can get is controlled by the employer. If there is financial crunch, what companies do, what employers do is to reduce expenses. And one of the ways to reduce expenses is to cut down the workforce, to cut down on the personnel cost. And whenever they do that, somebody in the E quadrant loses his or her job. Two, somebody in the E quadrant does not have control over his time. You can't just wake up one day and say you want to travel and come back in the next 2-3 months. When you come back, you lose your job. So, when you wake up, when you go back to bed, when you travel, when you have to return, how much you get is determined by somebody. Those in the S quadrant, these are the self-employed. Yes, they have specialized skills. Yes, they may have their own business, the small businesses. Like lawyers may have their chamber, okay? Specialized skills to render. But the danger here too is for them to keep making money, they must keep working. Any day they cease to work, that day they cease to earn. So the two quadrants on the left-hand side must keep working all the days of their life to keep earning all the days of their life. So if for any reason, let's say or for health reasons, they become incapacitated, money stops coming. Now, those in the B quadrant, the big business owners, on the other hand, they don't work. People work for them. They only supervise. They can travel and come back, and the company is still running. All they need to do, they don't need to work harder to make more money. They only need to hire more intelligent persons to work for them to make more money. So when there is economic crunch, where there is need to cut down expenses, the person on the B quadrant will ask a question: how many persons do I reduce to cut down on my personnel cost? While the man on the E quadrant will be praying, let it not be me. So you can see that those in the B quadrant controls the future of those in the E quadrant. So someone in the B quadrant is more financially free than someone in the E or the S quadrant, because the E and the S needs to work harder, get more certificates to get more money. The person in the B quadrant may not even have the certificate, but he can employ those with certificate in the E and S quadrant. Now I'm talking of the I quadrant. This is the investor's quadrant. It is at this point that you become financially free. This man has money. He invests his money is making more money for him. So whether he travels for a year and comes back, so long as the money is making more money, he comes back richer. Whether for health reasons he can't work, his money is somewhere working for him. So as a man or woman looking forward to be financially free, you need to look forward to be in the I quadrant. All right? What is my advice? Do not remain only in the E quadrant, an employee all your life. You see, it is so sad today. People work till the day they are to retire, and when the time comes for retirement, they begin to frown. Why? They don't want to retire, not because they love doing the work, but because they know if they retire, they will earn not as much as they're earning again. They know that if they retire, they may no more money like they're making while on active duty. It shouldn't be so. You can earn money from all the quadrants if you know how to go about it. What do I mean? Someone can be in the E quadrant, all right? You can see somebody in the E quadrant, you're working, you're earning salary, you don't stop there. Make sure part of your salary goes into the I quadrant. So you are an employee, but becoming not an investor. Build the I quadrant from the E quadrant. Become an investor while working as an employee. I won't say, okay, because the employee quadrant is dangerous, you may lose your job, and blah, blah, leave, quit your job. No. Remain there. Build your investors quadrant. It will come to a point where your investment is heavy, that the money you begin to make from investment outweigh your salary. At that point, you can fire your boss. Now, look at the man in the S quadrant, the self-employed. Yes, you are a professional working hard to make more money. What do? Build your investors quadrant with the money you're making from your services. Move part of the money you're making from your services to the investors quadrant until it comes to a point, whether you work or you don't work, the money in your I quadrant is giving you more money than you're making from your active service. At that point, you can retire. Then in the B quadrant, even though yes, the person in the B quadrant is safer, okay, and more stable than those in the E and S, crisis can come up. Business can fold. There's so many uncertainties in running business. Risks, you can take a risk and the business will not survive it. So what do? While you are a big business owner, invest part of your profit. Build your investors quadrant from your profit. It comes to a point where your company is earning money from the investment it has, such that if for any reason the company folds, you don't go broke. So what is the advice? Wherever quadrant you find yourself, build your investors quadrant. Aim at becoming an investor. And how do you be an investor? Save. Put your money somewhere. that will give you more money. There are so many investment channels, legal, safe, good yielding investment channels that we're going to be discussing in subsequent presentations. Why did I say you should not remain in the E quadrant? Because most employees end up in the rat race. At this point, I want to ask, have you heard of the rat race? For those of you who have heard of the rat race before, I want to elaborate more. And for those that have not heard about the rat race, you need to know about it in order to escape it. Now, there is something our parents taught us that we too are not teaching our children today. What is it? You advise your child, my son, go to school, study hard, get good grades, find a safe and secure job. This is what we all do. Now, what next? After he gets a safe and secure job, what does your child begin to do? He remains an employee, he gets married, raises a family. At that point, the expenses begin to increase. So what do? You need to work hard to meet up with increasing expenses, possibly go for further studies, get more certificates, to get promotion, to get more money. And finally, what happens after that? A time comes for retirement. What happens after retirement? Most times, we realize that it is in preparation for retirement that people begin to learn business. Now, you spend active part of your life working for the government or a company or an individual. It is when you are to retire that you begin to learn what is business. What do I do? It's not done that way. Business is not what you just learn 1 to 3 weeks just because they give you a retirement benefit and you dabble into it, you fail. So, what happens after retirement? Most cases, people still look for another part-time job. Retirement is supposed to be time for you to rest. But in most cases, we don't rest because when you rest, money stops coming. Or others learn business after retirement. Now, this kind of ideology leads to a trap called the rat race. It's a lifestyle of working all your life in order to meet up with your ever-increasing expenses. Look at that man where is he running to? Nowhere. So you need to escape the rat race. Plan your life, plan your finances, make sure in as much as you want to live your life, part of your monthly earnings, part of your wages should be channeled toward what? Investment. Now, for you to be financially free, for you to be able to be free, for you to be able to build that your investors quadrant, there's a very important thing you need to understand. We have looked at what the cash flow quadrant, and now we're looking at what the cash flow pattern. There are two things you must understand. Why this is important is this. If you mistaken one for the other, you will remain poor all your life. What are these two things? Asset and liability. An asset is anything that puts money in your pocket. A liability is anything you own that takes money from your pocket. Basic definition. Now, what keeps us poor is the fact that we're mistaking liabilities to be asset. We keep working, accumulating money, and buying liabilities, thinking we are buying assets. The liabilities keep taking more money from us, and when we retire, we realize that we can no longer service the liability. Before we continue, at this point, you need to know your financial net worth. To know your financial net worth, carry a piece of paper and a biro. Divide the paper into 2 columns. On the left, write asset. On the right, label it liabilities. Now, whatever you know you have now that gives you money, list them under the asset column. Whatever you own now that takes money from you, list it under the liabilities column. Now, you will realize, most of you, that the liabilities column is longer and more than the asset column. Now, when you finish listing all this, quantify them in monetary value. Add the total, the sum. All right? You now know your total asset and your total liability. When you subtract your total liability from your total asset, that is your net worth. All right? You subtract your total asset, your total liability, from your total asset. In other words, total asset minus total liability is your net worth. It will be so shocking to see many of you with negative net worth, meaning your liability is more than your asset. So long as you have a negative net worth, you are poor and you can never attain financial freedom because you'll be working all your life to service your life. So what do? Sit down at this point and tell yourself the truth. If you have a negative net worth, begin to concentrate on building your asset column and reducing your what? Liability. If you have a negative net worth, it also means that you are in debt. You took loan to buy a car. You took loan to buy a house in a choice location where you are living in. Now, let me tell you one. Your personal house, 4-5 bedroom, is not an asset because you live only in that house. No one is paying you money. Rather, you're the one servicing the house. But when you own a house and you put it on rentage and tenants pay you rent, classified under asset. Your personal car that you drive around is not an asset. It's a liability. You can call your car an asset if only it's for commercial use. Your generator set at home that powers your home appliances is a liability. You fuel it. Your generator set that powers your office equipment is an asset. So why am I saying this? You can own an item that is either an asset or a liability depending on its use. Look at the income statement of an average civil servant, of an average employee, of an average poor man. He gets a job. From there, it becomes his source of income. That's his income statement. As soon as the money comes in form of salary, it goes directly into buying as what? School fees, car loan repayment, house rent, utility bills, and that forms what? His channel of what? Expenses. Can you see? So this person gets his job, is earning money from the job, but the entire money is going out what? As expenses. Now look at this person. He gets his salary, which is a source of income, right? Now he uses his salary to buy assets. Okay, he buys invests into real estate. He has stock, mortgage. He has a farm and intellectual property, and there are so many other ways to invest. Now the money he is making from his asset becomes additional source of income. So you can see this person have two sources of income now. One, his salary. Two, the money from his asset. Now watch. His asset now takes care of his liability. The money he makes from these assets is able to take care of his expenses, which is what? School fees, car loan repayment, house rent, and bills. And that's how the money goes out. So you realize that this person has two sources of income. His salary goes directly to assets. His salary does not deal with his expenses. It is the money from his assets that deal with his expenses. At that point, even if his salary stops coming, the income from his assets is able to take care of his expenses. He won't go poor. This is the difference between the rich and the poor. The poor depends on his or her salary to take care of his expenses, while the rich use the salary as a seed. All right, plant it, it grows, and then the fruit from the seed he planted begins to take care of his expenses. Now look at these three categories of people: the poor, the middle class, and the rich. You can see from what I've explained before, the poor gets job, the salary comes as income and goes as expense. In most cases, before the salary is paid, he's already owing. He gets the salary, settle the previous debt, and begin to accumulate another debt. The middle class, they get a good job, use the income from the job to buy liabilities, and then it goes as expenses. What do I mean? Because the job is so good, they are big, banks go after them, come and take car loan. They take car loan and buy big, expensive clothes, expensive jewelry, expensive electronic, rent a very big apartment. It all goes as what? Expenses. No savings, no asset. Now look at the lifestyle of the rich. His source of income is his asset. So long as he doesn't have an asset, to him, he has not started making any money. So any money he makes, he invests it first into assets, then his asset becomes his source of income. At that point, you can become financially free. Way forward. Change your philosophy. Poor people spend their money and invest what is left. The rich people invest their money and spend what is left. Can you see the difference? The poor spend their money, and whatever is left can be invested. The rich, on the other side, prioritize investment first, and whatever is left cannot be spent. Ensure to invest a fixed percentage of your monthly income. Now, this is a recommendation I'm giving you now. The 70-10-10-10 rule. What does that mean? When you get your salary, take 70% of it and spend it as you deem right. Remaining 30%, right? The remaining 30%, 10% go for tithe. If you're a Christian, if you're a Muslim, there is religious principles that you have to observe. Whatever religion you are, I'm sure there's room for help, alms, and so on and so forth. And then 10% goes into active capital and 10% as passive capital. Now, 10% active capital is if you have the time to invest something that you too can run. And then passive is where you can throw your money while the money run and yield interest for you. In other words, 10% goes for your religious obligation, while 20% goes into investment. Don't forget the 70% is still there for you. But this remaining 30% must not be touched. It must not be touched. If you can do this, you may not need to wait for your retirement date to retire. You are allowed to alter this rule to meet your strength, but make sure you're consistent to it. Your salary is a seed. Plant it, let it grow. It's an egg. Nurture it, let it be hatched. Do not eat your egg. Do not eat your seed. Look at this diagram. This person, his source of primary income has stopped. Now, the pot you see here, like your bank account, the water you see here represents money. Now, once the source of money stops and his expenses are fixed, he must settle housing, he must service his car, he has to go to hospital, he must recharge his phone and other things, and he must buy food for his family. These expenses are constant, and it is from this pot that these expenses are fed. Imagine now that this person's source of income is no longer coming. Do you know what is helping him now? The extra income he's making from his investments. So long as these other sources are there, he will not be poor. But imagine if this man had no extra sources of income. This water will go drain by these channels, and he becomes poor and broke. So what is the advice here? Invest. Get multiple streams of income before you retire. Looking at business ideas, like I said earlier, that will be in our next presentation. If you learn anything, post your comment. If you have questions, post your comment. I would like us to interact more. We're going to be doing episodes by episodes. And for many of you that feel you've learned one or two things in the course of this presentation, post a comment, like the video. All right, encourage me to do more. And I tell you, together, financial freedom is possible. Thank you. Thank you for watching this video. I know you've learned one or two things. Some of you may need one-on-one consultation. My email is in the description box. You can send me a personal email to request for my services. I'm also on Fiverr. The link to my Fiverr is also in the description box. You can order for my services on Fiverr. Looking forward to hear from you. And please subscribe to this channel so that you get updates. Thank you once again.